what is a portfolio? Portfolio is just a collection of assets. So you may hear the term portfolio and thinks it's a fancy, sophisticated term. It's just a collection of assets. So college students' portfolio could consist of, a bank CD and, you know, a ring. A real wealthy investor could have lots of stocks, bonds, real estate. It's just a collection of assets as a portfolio. What is the return for a portfolio? Well, conceptually, it's the total dollar return over the period divided by the portfolio value at the start. And what's the total dollar return? It's the cash flow generated by the portfolio. So if the portfolio's got, let's say, stocks and bonds, it would be all the coupon payments, all the dividends. Let's say it's got some real estate in there, all the cash flows from the real estate, um, plus the change in the value of the portfolio. So how much was the whole portfolio worth at the beginning? How much was the whole portfolio worth at the end? Take the subtract, plus the value of the portfolio at the start of the period. So it's really just analogous to what we've done so far with individual assets. But what's interesting and what's nice when you're dealing with a portfolio, another way to get at this is by simply taking the value weighted average of the returns of the assets in the portfolio. So what that means is the return on the portfolio is equal to a weighted average of the individual returns or the returns of the individual members in the portfolio, and when those weights are based on the value of the holdings for each asset. So each of those those are weights where you take the value of the holdings of a particular asset, which is the price per share, the price per unit times the number of units that are owned, and you divide it by, so here you got the value of the holdings of asset and divided by the total value of the portfolio. So again, what's our value of asset 1, asset 2, asset 3, asset 4, all the way out? For all the assets, add them up, that's the value of the portfolio. And how much of that is attributable to asset 1, asset 2, asset 3, and that is your weight. So you're simply taking a weighted average. Expected return over a period. So again, we just looked at return. This is a case where we're kind of backwards looking. We know everything. Expected return, we're forward looking. So we don't necessarily know what's going to happen. What do we expect? It's the expected total dollar return divided by the expected value of the portfolio at the start of the period. But what's the expected total dollar return? It's the expected cash flows, the expected coupons, the expected dividends, the expected cash for real estate, any other kinds of expected cash flows for different kinds of assets, plus the expected change in the value of the portfolio, the value at the end minus the value at the beginning, divided by the value that's expected at the start of the period. So again, very analogous to what we did with an individual asset, but now it's a portfolio. And another way to get at this is a value weighted average of the expected returns of the individual assets in the portfolio. So again, you can see this, I think, clearly as you've got a portfolio, and what's the expected return? Well, the portfolio's got a bunch of different assets, and each one has its own expected return. And you want to take an average, but you want to take into account how much of the portfolio is attributable to each of those assets. So you have a weight on each of them, which is simply the value of the holdings for that particular asset divided by the total value of the portfolio. So if the whole portfolio is worth $100 and one of our assets, what we own is worth $97, then 97% of our portfolio would be attributable to that particular asset. And so the expected return for our portfolio would be heavily influenced because 97% would be the weight on its expected return. So let's take a look at an example. We've got Sven Fredrickson. He has 3 stocks in his stock portfolio. He's got Google, Starbucks, and IBM. He owns $16,000 worth of Google, $14,000 worth of Starbucks, and $10,000 worth of IBM. So the total value of his portfolio is 40%. And if we want to get portfolio weights, we can see that 16 of the 40 is in Google. So 40% of his portfolio is in Google. 14 of the 40 is in Starbucks, which is 35%, and 10 of 40 is in IBM. So you can see it's overweighted in Google, a little bit in Starbucks, and underweighted in IBM. If it was equally weighted, it'd be a third, a third, a third, but that's not the weights. And a good check is to make sure the weights add up to 100%, because if the portfolio has 3 stocks, then the weight on those 3 stocks is going to be 100%. We know that the expected return on Google is 15%, the expected return on Starbucks is 20%, and the expected return on IBM is 10%. So what is the expected return of Sven's portfolio? Well, we can't simply add up all 3 and divide by 3, because that isn't capturing the fact that there's 40% of the portfolio is in Google and only 25% is in IBM, and it's not a third in Starbucks, it's actually 35%. So let's just take a weighted average. 16 of his $40,000 is in Google, which has an expected return of 15%. 14 of his 40 is in Starbucks, which has an expected return of 20%. And 10 of the 40 is in IBM, which has 10%. And if you do the math, you see that the expected return on this portfolio is 15.5%. And that takes into account the fact that it's slightly overweighted in Google and Starbucks and slightly underweighted in IBM. IBM has the 10%, while these other guys are at 15 and 20, and as a result, we wind up at 15.5%. If there were different weights on the portfolio, such that 30% was in Google, 45 was in Starbucks, and 25 was in IBM, you'd wind up with a different expected return for the portfolio, even though it would still have 3 stocks. The weights are really, really important.